I mentioned in my last video, AT&T, if you haven't seen it yet, that you might like to wait for this video before making an investment in the telecommunications sector. That's because we're going to be talking about Verizon in today's video. And it's pretty much exactly like AT&T and the services that it provides. So hey guys, it's Newfire, and today let's skip over the introduction for Verizon and get right into its stock. This is the 17th company in this series, and we have just 8 more before we're done. Though we're almost done with the series, investing is a lifelong process, so you can always apply 25 companies for 25 years. So back to the topic for today. Verizon went public 23 years ago at a price of $45 per share. Today, their shares are trading at around $36. Honestly, that's not a good look on the company considering they managed to peak at $61 just a few years ago. To put it into a bigger perspective, if you'd invested $1,000 in Verizon at its IPO, your shares would be worth $800 today, had you held on instead of selling. That's not a promising context for new investors, so let's try to find out why that happened and why one of the biggest companies in the telecommunications industry actually isn't doing so well. For one, Verizon's declining position in the stock market is due to several reasons, one of them being unable to beat out competition. AT&T and Verizon are competitors, along with some others, and though the industry is faring at a less than desirable position, Verizon takes the brunt of it. One of the other reasons both companies are struggling is due to customers leaving their services in search of better offers. Verizon continues to raise its fees, and so subscribers are leaving en masse, which is something investors have been seeing in recent quarterly reports. Because of this, investors lose confidence in the company to not only retain its current customer base, but to bring on new subscribers. And when the investors lose confidence, the stock takes a hit. In short, it might be worthwhile to consider the other stocks in this series, since they seem more optimistic than either Verizon or AT&T. When considering Verizon's performance over the past couple of years, they continue to lose subscribers and hike up rates, haven't delivered on promises of 5G data services, multiple management changes convey an uncertain future for the company, and last but not least, the declining stock itself. While Verizon is nowhere near the brink of collapse, we want to find companies that will grow our money, not lose it. Yes, Verizon does offer dividends, and the amount has been steadily increasing every few quarters. However, dividends are a secondary aspect to investing in a company. You can consider dividends if the company's stock shows signs of growth or is stagnant, but when a stock is on a decline, dividends are not the reason why you should invest in a company, as whatever you receive from the dividends is less than the money you lose out on the stock. And that's it for today. The past couple of stocks we've been talking about aren't the all-stars we want to see, but don't get your hopes down. We'll be moving on to completely different companies in my upcoming videos, so stay tuned for that. Remember to always invest wisely and try keeping your investments in 25 companies for 25 years. Thanks for watching, and this is Newfire signing out.